Charlie, if you look at the list of new highs today, Church & Dwight, General Mills, Hershey, these companies are trading at all-time highs. Coca-Cola and Pepsi and your beloved J.M. Smucker at the highest level since 2016. It's finally working for you, but I don't know what that says about the economy.
Yeah, this is a little bit tricky because I would say the reopening trade would not be helpful to those kinds of consumer staple names. They did so well, obviously, in COVID when everybody was home. Part of our thesis is that people rediscovered Folgers coffee at Smucker's when they could buy when they were at home and they didn't have to spend $6 at Starbucks. They could spend 60 cents on their cup of Folgers. But I have to admit, I am a little bit surprised that the consumer staples have performed so well. We would say this is a consumer discretionary economy where, again, the consumer has a great balance sheet, is ready to spend, and that should be good for discretionary items.
Well, earnings season does officially kick off this week, as we've seen, with J.P. Morgan and Citi closing in the red. Wells Fargo up 3% after reporting results this morning. Let's bring in Ed Yardeni, president of Yardeni Research, with more of a preview, Ed, for what we can expect. And which sector do you think stands out in terms of the best opportunity as far as the setup relative to what we're going to get from earnings?
Well, I think where we may still get earnings surprises, and this is the season for earnings surprises, typically analysts lowball the results that we actually get. I think energy is one area. I mean, certainly energy companies are spending less on capital spending, and at the same time, they've had higher oil and gas prices. So I think that's going to create some upside surprises in the fourth quarter results. Then I think the other areas, financials, they've been coming out, some sell-off on the news. The good news has been an opportunity for some to take some profits. But I think the important point is that loan demand is actually starting to come back. It had been very weak for the past couple of years as businesses especially were able to refinance in the capital markets. Industrials look great, especially things like electrical equipment, industrial equipment. And the reason that looks so good is because the orders numbers are an all-time record high. They're absolutely flying. I think supply chains are coming back to the U.S. of A., and I think that entails a tremendous amount of capital spending, and that's affecting industrials. Technology, too, by the way. I think sell-offs are opportunities to get into these stocks because I think technology is going to be used to continue to bring supply chains back home. And that kind of rounds it out for now.
It sounds like you're pretty tilted cyclically strong areas, industrials, right, energy, financials. So you are a buyer of the recovery story and yes, that Fed hikes and inflation won't stand in the way?
Well, think about it. If we get what the market currently is discounting 4 rate hikes this year, that gets us all the way up to 1% on the Fed funds rate. And maybe the bond yield will move to 2.5%. These are not killer interest rates, in my opinion. They were just really indications of a strong economy. The key, of course, is we need to see inflation peak and start coming down. That would help the markets a lot, and that would give another lift, I think, to the stock market broadly and cyclical specifically.
Ed, how much do you consider sentiment more broadly, as opposed to, the discount rate and how that should impact valuations? Right. And whether we just have shifted now towards certain parts of the sector to a new era where people want to take profits, right, rather than chase the momentum high?
Well, I think you are seeing a lot of investors conclude that being invested long-term makes more sense than trying to time corrections. I don't do corrections very well. I've had some success in timing the tops, but then the frustration is telling people when to get back in. And I think that's generally the case. Strategists who play corrections have to give you 2 correct decisions. One is when to get out and when to get back in. And I don't think there are too many strategists that have done a pretty good job of that. I would say that the key here is there going to be a recession this year because the Fed has turned more hawkish and is going to be raising interest rates? Will there be a recession in 2023? I don't think so. And if that's the case, then I don't think we have to worry about a bear market. And there could be some corrections along the way, but those will be buying opportunities rather than something to try to time.